Hey everyone, happy Sunday. It is the end of the weekend for most of us, so hopefully you guys had a good weekend. But super excited to have Jake with us today. He's been here before. He's one of the founding members of TrendSpider team, and a lot of you know that I post a lot of TrendSpider charts. So I'm a huge fan of what they do. And from what I understand, there's some new stuff in the works right now. So that should be
Yes.
exciting. I see Dan's always posting little tidbits of updates. So I'm pretty excited to see what's gonna come out this month and moving forward. So welcome back.
Thank you. Yeah, no, it's busy times right now at TrendSpider. We're working on getting our data feeds live. I think the first live release went yesterday for the ETF side of things. Then next weekend it will be stock. So we are upgrading those. And yeah, thank you so much for having me. And the mobile app will be coming soon. That's something that a lot of people ask for.
Yeah.
So that's coming out hopefully at the end of April. Based on development is an interesting thing. I've been in the startup world pretty much since I graduated. First more on like hardware software side, and TrendSpider's fully software. And 4 weeks in dev world means like 8 to 12. So they've told us end of April. I'm gonna go and say, let's say mid-May to June, but hopefully once the bugs are out, we'll be able to launch that, and that will give a lot of people access to TrendSpider on the mobile side of things. And today, I think we're really just going to focus on technical analysis, what it is, trend lines, moving averages, some oscillators that I like to use, such as the RSI, the Williams percent range. I don't use a ton of lower indicators, and lower indicators are pretty much anything just below the price chart. So we'll touch on the RSI and the percent range, and then how you can create alerts for all these different things. So before I jump really too far into trend lines, I'll just kind of tell everyone a little bit about what TrendSpider is. So it's a technical analysis platform. What is technical analysis? Pretty much technical analysis is anything that you're doing to analyze price action, using indicators to analyze price action, and being able to see the market in more visual terms rather than just looking at earnings and looking at what are the insiders doing, that type of thing. But at the same time, the platform is kind of a hybrid technical analysis platform, as well as things that aren't necessarily traditionally technical analysis. So seasonality. Let's say that you want to go invest in Apple, and you want to see, historically speaking, when's a great time to maybe get into Apple, or when is a month that Apple is typically down. You could go on TrendSpider and do all these things without having to go back and do that on your own time. So that insider trading is another one that's interesting. I'll actually go over an example of that today, just because it's pretty interesting stuff, especially with Facebook right now. But TrendSpider really started with the automation of trend lines, and so that's kind of how we got started. So today, talking about trend lines, how to draw them, will be pretty easy to kind of jump into, not only manually drawing them, but also how you can have the system draw them for you to kind of train your eye. So automated trend lines are something that we have not just for someone who wants to speed up the process of drawing trend lines. It could also be there for you to kind of train your eye on what should I be looking for and that type of thing. So first things first, a trend line is really just connecting two plus points on a chart. Now, most people will tell you, and I agree with this, that if you have a trend line, you really need to have 3 points on the trend line. So in this case, you can see here, let's say that we want to draw a trend line here. There's a million different ways to draw a trend line, and I'll actually just bring up the auto trends here to show you guys all the different ways that the system is finding these different trend lines here. All of these lines are created by just connecting different points on the chart. And if you're not familiar with a candlestick is just a way to measure price, what it's done within a specific amount of time. In this case, we're looking at the 1 day time frame. So let's say that we zoom in here.
I think you might want to share the screen just to make sure.
Yep. Yep.
All right, got
That
it.
would be
Perfect.
helpful. There's the visual side of this. Okay, awesome. Thank you for mentioning that.
Perfect.
Yeah. To kind of recap here, the system really can automate things. It can show you seasonality. As you guys can see on the chart here, this is the trend line side of things. And so with a candlestick that I touched on, we're just looking at a time frame here. So there's really 4 parts to a candlestick. Let's take this one, for example, here. This one kind of has wicks and bodies. So you've got the low of the day, you've got the high of the day, and that's created essentially these wicks here. So if you're familiar with like a box and whisker plot, this is kind of what that looks like, except just showing what price is done. So your wick down here is pretty much showing what price is done. So the body is your open. That means at 9:30 a.m. Eastern time on a specific day, what price did the stock start at for the day? So in this case, on March 25th, you'll see here that we opened at $386. You can see that throughout, at one point in the day, the price dropped all the way down here to around 383.80 or 90 or so. And then you can see to end the day, we closed way up here at around 389.50, but we actually hit a little bit of a higher point here before closing a little lower. So, when we're drawing these trend lines, we're connecting essentially either the bodies or the wicks of these candles. In this case, we'll just do the wicks here. And so you'll see here that there's as you guys saw quickly with the auto trends, there's a lot of different ways to draw trend lines. I'm just going to draw an example here. Let's say that I want to draw this point here to this point here. You'll see that this is a pretty strong trend line because price has respected this area, multiple times. And one thing that you'll recognize or learn really quickly with trend lines is the fact that it's not ever going to be perfect. So for example, I could go in, and if I wanted to be really precise, I could go in and draw this trend line starting here, like the first line, but maybe I connect it to this wick here, and you'll see that, we kind of have a zone rather than just one trend line. And so I personally like to use a trend line as a line of best fit. You'll see here that there's a couple times where the price doesn't respect this trend line perfectly. But that's okay. Price is not perfect, and it's never going to be perfect. There's a lot of participants in the market that have influence on price, whether that's an institution, whether that's somebody that may be too leveraged, and they have to buy something back and pushing the price above a trend line. So one thing about trend lines and technical analysis in general is it's never going to be perfect. You're never going to have price touch something absolutely perfectly. So to go off of that, that's why we created something called the sensitivity alerts. Now, you can see here over the last couple days, we were kind of riding right up along this trend line, and then finally on Friday we broke through this area. So you'll see here this is clearly a breakout, and something to note going into the week ahead, that there's definitely strength in the market. But you can see that, this is a pretty strong trend line. I generally don't even really like to use trend lines that are only 2 points. So the original point connecting another point, that's always how a trend line is going to start. But if you only have 2 points on the trend line, it hasn't really proven itself. Whereas this line here, starting from March 2nd, and really extending all the way out to early April, this has proven itself multiple times as an area of interest. And if you're new to technical analysis and you're new to trading, the one thing that you really don't want to do is just stare at the screen all day. It's good to get a sense of how prices move and how sometimes price action can be very random. So I'd say that's a good reason to watch price maybe all day when you first start, but don't watch price all day because you want to just be obsessed about your position. Looking at the chart and staring at it and you have a position just makes you antsy. if you're just trying to press the buy or sell button all the time, there's really no process there. So in
Right.
this case,
And I
sorry.
was just going to say, and also people need to understand that there's so many different ways of doing this. I mean, we're talking about trend lines right now, but then there are moving averages. We're looking at, a lot of people look at the 200-day moving average as sometimes the bottom when it comes to when things start bouncing off of that. But before you talk a little bit about the trend lines, just tell people about the red candles too, because the solid red are on down days, but then you've got the hollow reds that is where the price is starting at the bottom, towards the bottom, and then closing on a higher note. So just, if you don't mind, talk to people about a couple of those other candles that you see on the screen there.
Yeah, sure. So there's a couple different types of candles. This is what's called a hollow candle. If we split the screen and we see the hollow candle versus a regular candle, most people use this type of candle. And you'll see here that there's some slight differences. I mean, at the end of the day, you can use both. For me, a hollow candle just tells me more information. So
Okay.
for example, let's go over this candle right here. This candle is a hollow red candle. What does that mean? Well, it means that, and let's zoom in here, see if we can really, I can't zoom in that great, but so same thing, right? We just went over a candle. Your low is here, your high is up here, your open is here, and your close is here. And I'll just, I'll label that real quick. So high, this is the high of the day here. This is the low of the day down here. That means that's the lowest point that the price hit. This is your open. How do we know it's our open? Because it's a hollow candle. A hollow candle, anytime you have a candle that isn't filled in with either dark red, or in this case, you can see in this candle, it's dark gray. The color is a function of the previous candle's close. So for example, here, open, high, let's do the closes here. The hollow red means that, one, it's red because it closed lower than this candle here. So you'll see here, notice that we closed here on March 26th. You can see that we closed, so that was a close of 395.95. You can see here, right here, it's 395.74. So we closed as a red candle because it's lower than this previous close. Now it's a hollow candle, and notice that you either have a red solid candle or you have a red hollow candle. It's hollow because your open was at 394 and your close was up here at 395. So the way I like to teach this is essentially like opening or closing a window shade, right? So if you open at 395 and you close at you open at 394 and you close at 395.70, it's kind of like opening the window shade because your close is higher than your open. So it's hollow because of that close is higher than the open, but it's red because you closed lower than the previous day. Now, here's another example here. We'll move this over. So here's your low of the day. Your open is actually up here. Your close is down here. This is going to get really tight. I'll zoom it in. And then your high is here. Now, kind of going over these different things, the reason why this is now a solid gray candle is because we closed on March 9th at 387. We opened the next day at 389, so we opened much higher than what we closed at. However, you'll see that we closed at 389.51 and we opened around 389.72. So this is going to be hollow because our open was at 389.72 and our close was here around 389.50. So it's like closing the window shade. So it's not red because we still closed higher than the previous day. Now, if you look at a regular candle And same thing with the red, right? If we have a solid red candle, that means that one, it's red because we closed lower than the previous day, and it's solid because we opened way up here, let's say at 390, and then we closed way down here at 388. So you can either have a hollow red, you can have a hollow white candle, you can have a solid white candle, which is going to show up as gray, or you can have a solid red. Now, if you use regular candles, notice here that we have 3 hollow candles here, 3 hollow red candles. But if you look at the regular candle here, all of these candles are green. So when you're looking at a regular candle, the color of the candle is simply just a function of if you closed higher than your open.
Right.
So here it kind of looks like, oh, this was a green day on March 29th, and I'll highlight this, right? This technically closed higher than what it opened at, but it still closed red for the day. So for me, I want to know if it's a red day or a green day. And when we say if it's a red day or a green day, it's a function of the previous close. Well, with candles, you have a green candle because you're just closing higher than what you opened at. But with the hollow, you're getting more information there. You're seeing that, okay, yes, we did close higher than what we opened at, but we closed lower than the previous day. And you can't always see that well if it's pretty close. You know, you're like, is that, you know, was that higher or was that lower? So the hollow candle definitely gives you more information a lot quicker. And you don't have to go squint your eyes and say, oh, is it, you know, was that close higher? So personally, I like to use the hollow candles because it just gives you more information a lot quicker. But a lot of people like to use the other ones. Now you'll notice that the volume is the same. Notice that the volume is green since pretty much March 25th. If you have a hollow red candle, the volume is going to register as green volume. It's weird. It's not just on TrendSpider how that is. It's on any platform. So if you do have a hollow red candle, it's actually going to show up as green volume. So that's the same on both. And you'll see that here. So what is a little concerning to me, right, going into next week is the fact that we literally have had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 green volume days in a row. That does not happen very often.
And I think part of it I see is that the volume is declining. So you know, one can argue that the buyers are starting to kind of maybe dry up a little bit. So we'll see how that trends next week.
Yeah, exactly. So you're trending lower on the volume. Now keep in mind the volume you know, is declining, but you're also having volume at a higher price. So as far as the money goes, you know, you can have a little bit of a smaller candle at a higher price and it's still the same amount of money. Now, the actual shares transacted is lower. So yeah, I agree. I mean, you generally don't want to see declining volume when the price is kind of melting up like this. So we'll see what happens. I mean, we did break out of this resistance line that's kind of, you know, been something I think a lot of people have been watching, and we know that because it's been tested multiple times now. I mean, it's been tested quite a few times. Now, what's interesting is, as I mentioned, a lot of time you don't want to stare at the screen all day. So, you know, notice how the price got close to this trend line multiple times over the last week, but it didn't actually touch this line. So, you know, maybe you're just wanting to trade very quickly and you just want to trade anytime the price gets near this trend line. You can use something what's called sensitivity on our alert system. So if I right click on this trend line, you'll see there's a few different ways to look at this, right? You can either be alerted when the price actually breaks through the line. So you'll see here, these are the different boxes. So a breakthrough, a touch, or a bounce. So if you simply just want to know whenever the price breaks through this line, you would choose this breakthrough alert. Now, if you only want to know whenever the price gets anywhere within a specific amount of this line, you would use something called the touch alert here, and that's the middle one. And you'll see that I can increase the zone around this trend line. I don't have to be right on the money. I can be within, you know, a couple dollars or 50 cents of this line. You'll see here the alert fires within, in this case, 50 cents of the selected line. So you can add some margin of error around that line, so you're not having to be right on the money here. There's a lot of times where the price won't, you know, get exactly to a trend line, and it will reverse before you can take advantage of it, because a lot of people have these levels and it's like, yeah, I'm watching 411.39. It's like, well, yeah, okay, that's like a reference, I guess. But generally, if you're looking at levels in technical analysis, you want to have some margin of error around that. There's never going to be a time, and if there is, it's likely a coincidence that you're going to test a level perfectly. It just doesn't. It doesn't happen consistently. You're always going to have some of that you know, that price action around these lines. So you'll see that happened a couple times. So using the alert system on trend lines can either give you an exact time when the price breaks through. As I mentioned, that's when you really use the breakthrough. You wouldn't need to use sensitivity if you only want to know when the price breaks through this exact line. That's when you just use this breakthrough here. But if you did want to have some margin of error, and let's say that you're watching a trend line that price has reversed before it got exactly to that line, that's when you'd use the touch feature here. And it just makes life easier. You don't have to watch, you know, the screen constantly. You get a email and you get a text message when the price breaks through. So, you know, you get your text and you're like, okay, price just did something. Maybe you've created 30 alerts and you don't remember, you know, what was I watching or what was my idea here on SPY. You can go and make a note here and you can say, you know, breakthrough on SPY, trend line, go long, whatever the case is, you know, or maybe possible overshoot of the trend line, short here. Shorting is just when you're betting that the stock is going to go down. So there's a lot of different ways that you can play this, and that's what makes the market. Everybody's looking at the market differently. And so this is a great way to not have to be staring at the chart all the time. It's not healthy to do that. It's not going to really make trading any better because you're just you're micromanaging your trade. Micromanaging in my life has never been a good thing. And same thing with trading. You don't want to micromanage your trade unless maybe you're trading really short-term options and you really need to, you know, get out quickly. Then it makes some sense. But for the most part, especially as a swing trader or position trader, that's what I am. I'm more or less entering a position for longer periods of time, couple weeks, maybe even a month or two. So I'm not really too concerned what happened every 30 seconds. But if you're a day trader, I could see, you know, maybe you want to be in the screen, in front of the screen constantly. But at the same time, this is a reality in technical analysis. If you're day trading and you want to watch 30 stocks, you can't watch 30 stocks all at once. And that's where the alerts will also come in handy. So, you know, it allows you to manage a bunch of different ideas or charts that you're watching. So even if you are in front of the screen all day, you can get these alerts as the price touches, because it's impossible for you to be staring at 30 different screens at once. So the alerts are either good for, you know, allowing you to stick to a plan and only, you know, going back to the chart when that alert has gone off, or if you're really trying to manage a ton of different stocks at once and you're watching the screen constantly, this allows you to get those alerts, and then you can say, okay, I need to look at this screen or I need to look at that screen without having to, you know, just absolutely go crazy. So the trend lines are something that you can draw manually. This is what I did here, but you can also have the system draw these automated for you. So we have something called trends here. If you click this button, you'll see these different trend lines pop up. And these trend lines are just created by the algorithm on the back end. And, you know, one thing that's important to note, these are not TrendSpider's trend lines, right? There's a lot of trend lines out there. So we have different preferences, and you can change the algorithm or the back end formula so you're looking at maybe something else. So, you know, there's 3 different types of preferences that you can change. You have the analysis type, which is really looking at the distance between the candles. I like to use enhanced because it's generally finding the patterns or trend lines that I'm looking for. I'm generally looking for ascending wedges. Ascending wedges is essentially just when the price is starting to move up and starting to narrow. So here you'll see here that the price is actually in an ascending wedge right here. And all I'm doing is I'm just double clicking these trend lines that I want to lock in. So I just double clicked this trend line here. I just double clicked this trend line. Oops, wrong one. Just double click this trend line here. And then when I turn off trends, we have two lines that stay on the chart. And so, this allows you, especially if you're going through 30 or 40 charts in a night, you don't have to go draw the trend lines over and over again. You're able to go and actually have the system highlight these areas that you're likely going to be looking for anyways. And that's where the preferences come in. I personally like to use enhanced, wick, and drawing input is just, are we starting at the wick? And remember, the wick is either the highest point or the lowest point on a candle, or we can start from the bodies. So we're connecting the bodies, either the open or the close on the candle. And you'll see that, this will slightly change how the lines are drawn. So that's something to keep in mind where, this is not something to replace your analysis and just kind of make the whole process completely automated. It's there to be an idea generator for you. So when you're going through you're going through your watch list of 30 stocks, you don't have to go draw these lines. It's generally finding the lines that you are looking for anyways. And you'll find, you'll find the preferences that work for you. But for me, analysis type is enhanced. That's kind of the middle of the road. Original is going to find much wider trends, kind of trends further apart. And sometimes it doesn't even find one. So that's kind of why I don't really have original on ever. In this particular case, it's not finding any. So enhanced is what I like to use here. And then, I just go from there. So I double click here, I double click there, I lock in the trend, turn it off. And now, for me, maybe I just want to know when the price gets to this line. Or, another thing is a lot of people won't even take this trade until the price breaks through or breaks down. What the price could do this for the next long time, for months, and just go back and forth. And someone may not trade that. Somebody else may say, oh, that's a great buying opportunity at the bottom, and then I sell at the top. There's so many different ways to trade, but the nice thing is you just create your alerts, whether that's an alert for a touch, whether that's an alert for an actual breakthrough. You get to choose what the price action is going to do. And that's something that's really nice and kind of takes away the emotion. You just say, hey, I'm going to either go long here, go short there, let the alert go off, and then you stick to a plan. So this actually helps you kind of stick to a plan as well. If you're over here and the price is getting close and you say, okay, I'm just going to buy before it breaks out, and then it reverses, you didn't really stick to your plan. You just kind of were like emotional about it or just impulsive, which, is hard not to do in trading. It's easy to just say, well, it looks good, I'm just going to buy it. But a lot of the time, it's kind of like in blackjack, right? If you're playing blackjack and you stick to some type of strategy, at least like there's consistency there. Whereas if you're just like, okay, I'm going to hold on to 14 this time, and then I'm going to hit on to 14 next time, there's no statistics or any type of consistent plan that you're sticking to, and it's hard to stick to any consistent games. Not trying to compare blackjack to trading, but there's similarities. You're trying to stick to some type of strategy so you have some type of consistency in your plan. Same thing with trend lines. Now, I'm not sure if there's any questions on the trend line side of things, but if not, we can jump into moving averages. What are moving averages? How are they used? And, the main thing is they really just become self-fulfilling prophecies at the end of the day. And that's why they're useful. There's nothing really, supply and demand oriented about a 50-day moving average. The reason why there's demand at the 50-day moving average or, price action that respects it is because a lot of people are watching the 50-day moving average. Now, you have a simple moving average, and then you have an exponential moving average. The simple moving average is kind of how it sounds. It's a simple mathematical equation. You take the last 50 closes, you add them all up, you divide it by 50, and that's your moving average value for that most recent day. Now the exponential moving average, and I'll show you guys an example here. If I have one, I may need to add one here. So exponential moving average, and we'll make this 50 as well. You'll see something pretty interesting on the visual side of things. Let's just turn off the 200 for now. Okay, let me make the stroke a little thicker so you guys can see it. I'll just keep like that red. So you'll see here, the blue is the simple moving average, and then the red is the exponential moving average, both looking back 50 days in this case. So, you know, when you hear the SMA 50 or you hear the EMA 50, you know, that's looking back 50 periods. So in this case, we're on the daily chart, so that's looking back 50 days. If you're looking on a 30-minute chart, you're looking back 50 30-minute time intervals, which essentially 50 30-minute candles. So, you know, when you have a simple moving average 50 or an exponential moving average 50, you have to look and see what time frame you're on, because you can't just say, oh yeah, that's the SMA 50, that's the 50-day simple moving average, because it's not. If you're on a 30-minute chart, it's the last 50 30-minute candles. So just something to keep in mind. This is something that is independent, or this is dependent on whatever time frame you're on. Now, what I was going to point out here on the SMA versus the EMA, as I mentioned, both of these are looking back 50 candles, in this case 50 days. Notice that the EMA 50, and we'll just highlight this, EMA 50, moves faster, is more reactive to recent price action than the SMA 50. So you'll see here, notice how the EMA 50 on November 4th starts to really curl up quickly. That's because it's taking into account this most recent price action. It's adding more weight to the most recent price action. Whereas the SMA 50 is only looking at 50 days back and applying the same weight to each close. So that's why it's not really moving as quick. But the EMA 50, it's taking those, I'm not exactly sure off the top of my head what the exact formula is, but it's taking the most recent candles and it's applying a higher weight. And that's why you'll see that the EMA 50 is curling up faster, because it's taking into account this big move that we had right after the elections. So, it's really a personal preference. I think a lot more people probably use the SMA than the EMA. So, if you're looking from a self-fulfilling prophecy standpoint, the EMA is probably not going to hold as much weight because there's not as many eyes on it than the SMA. Generally, people are looking at the simple moving average 50 or the 200-day simple moving average. So you can see here on TrendSpider, I just click this button here, and you'll see that you can see that this is lower because we're taking into account a lot more days. We're looking back 200 days, which has a lot more lower prices than only looking back 50 days. So you're looking at more of a recent trend on the 50 than the 200. The 200, you'll see here, did act as pretty good support here a few times back in 2019, but it's not always that correlated, and each stock has its own personality. If you have a ton of market participants trading the 200-day SMA on a specific stock, then it's probably going to be an important level, and you can tell that just by looking and seeing if price respects it. So the nice thing about this is on TrendSpider, you can have different time frames on a single chart. So a lot of the time, if somebody wants to see what's the daily price doing and maybe what's the weekly price doing, you would need to go, you'd split the screen, you turn on the weekly candle. So now each one of these candles is representing price action within 1 week instead of price action within 1 day. And if you wanted to see what's the weekly SMA 50 look like, you'd have to go in and add it. You can see here that it's right here, and then the EMA 50 is here, and you'll see that looks very different than what's on the daily. Now, if you use MTFA, which is multi-time frame analysis, you can still look at the daily candle, but then you can actually overlay the weekly moving average onto the daily chart. So you don't have to have two split screens. You can have one screen with that longer term moving average or longer term level on the chart. So for me, I personally like to do this just because it consolidates the chart. I like to use Bollinger Bands. A Bollinger Band is essentially a 20 period SMA. So it's taking, so if we turned on, so this is the Bollinger Band, the middle band is the 20 SMA. So if we went and just turned on, let's see, do we have one on here? We can change this to 20. So if we turned on, you know, the weekly SMA, you'll see it's the same thing. So the Bollinger Band, what it's doing is it's showing the 20 period SMA on the chart, but then it's showing the top band and the bottom band, which are 2 standard deviations from the SMA 20. So this upper band is 2 standard deviations above the SMA 20, and then this lower band is 2 standard deviations below the SMA 20. So this allows you to kind of see overall the volatility, and you know, as the price action starts to really trade in a range, you'll see that the Bollinger Bands get tighter because you don't have as much volatility between the prices over that 20 period time frame. So what I like to do is I like to look and see, okay, well, you know, anytime the price gets above pretty much 2 standard deviations above this SMA, it gets a little iffy. You know, you'll see here that it doesn't happen often. Going back over the last 2 years or more, there's not a lot of times where the price is actually above this upper Bollinger Band. You'll see here that it sometimes will just ride along it, but you'll see anytime the price does get way outside of it or even a little bit above it, you generally have a pullback. And that's what happened in early September. You had the price starting to poke its head above this upper Bollinger Band, and that was kind of a little bit of a red flag. Now, notice what's happening here. Same thing, we're starting to pop above it. Now, one thing to keep in mind is this does update a little late. So, you know, over the next week, the Bollinger Bands are flexible. They can move up with price. So we have to see, is this actually going to close above it once we get this new updated Bollinger Band into next week. However, Facebook's a good example of this right now, and Facebook's a lot more extreme than the S&P 500, but you'll see the same thing. Back in August, price was definitely poking its head outside this upper monthly or upper weekly Bollinger Band. We had a pretty strong move down, and notice what happened. Price moved right back down to this SMA 20 and literally respected it for months. So you can see that the SMA 20 for Facebook is an important level to watch. And how do we know that? Well, because price respected it multiple times once we pulled back from being way outside that upper band. Now it's happening again. It happened back in March. You can see here that we popped above it and pulled back pretty sharply. I think we hit a high of around 300. We pulled back all the way down to around 278. Now we have started to move up again, hitting a new higher high. And you'll see we're pretty far outside that upper band. You know, even if let's say this band continues to move like it is, it's still outside of it. And so that's something to keep in mind. We are starting to get a little overextended, and definitely something that, you know, I like to look at a lot. I mean, if the prices have really started to move up quickly, I'm always looking at, I always pull up the Bollinger Bands. I don't use them that often, but Twitter was another good example of this. You know, I looked back at Twitter about a month and a half ago or so, and I'm like, well, price is starting to get pretty far outside these Bollinger Bands. And anytime that's happened in the past, we generally had a pretty strong move down. And notice almost every time the price moved back down to this SMA 20. Now, this is where the sensitivity comes in. We did it once. We got outside the upper band. We pulled back. We hit it right on the money. We got outside the upper band again, moved right down, almost actually undercut it a little bit. But then notice this time, we pulled back and we didn't necessarily get right to that SMA 20. So this is really where that sensitivity comes in nicely. So if we right click, and let's just get rid of this, this orange line. We know it's the same thing. So if we right click, create an alert at this line, and we added some sensitivity here, we would have been alerted whenever the price got within this purple zone, and you would have been able to get that alert before the price actually had to get all the way down to that middle band, which is, as I mentioned, just the SMA 20. So the alerts are really nice because you really just let it becomes just a very mechanical process. If the alert goes off, I look back at the chart. If the alert doesn't go off, then I don't look at the chart. And that's how you can really keep your head stable and not making emotional trades and that type of thing. So
draw the arrow with a percentage on there, and it's kind of cool because if you got in at that level, I mean, you would have been up 15 to 17% since then.
Yep, exactly. So sometimes maybe the price did pull back a little more and you got in a little early, but even if you got in at 62, you still would be up well over 12% at this point. You'd be up 13 or 15% here. So this just allows you to have some type of plan, allows you to define the levels that you want to watch. If those levels are hit, you get back on you get back on the computer, you look at the chart and you see what happens. Now, another thing that I like to look at is the RSI, which is a very common indicator. That's something that's on almost all platforms. And it's a very, very well widely known and used indicator. Now, the RSI is something that is an oscillator. It just oscillates between 2 points in time. Or excuse me, two values, not 2 points in time. It oscillates between 0 and 100. You'll see here that anytime the price starts to dip quite a bit, you'll see that the RSI starts to dip below this threshold. Generally, most people look at 30 to 35. If you wanted to, you could go in and change this. So I have the lower threshold at 35. I could change this to 25 if I wanted to, and you'll see that that line changes. And each stock is going to signal. Maybe one stock rarely gets below 30, so you probably wouldn't want to set your threshold at 25 because you're never going to get oversold. Whereas another stock may take until it gets to the RSI 20 to become truly oversold. So each stock has its own personality. I generally like to use 30. That's pretty generic, as well as 70 as the top threshold here. But you'll see that, generally the RSI will tell you when things are getting overbought. Now, the problem is there's a lot of different lengths in time you can go back. This is the RSI 10. So the RSI 10 is essentially looking back 2 weeks. There's 5 trading days in a week times 2. That's 10. You're essentially looking back 2 weeks. The default is 14. That's a pretty random number. I mean, 14, technically, if you're looking at a week, there's 7 days in a week, but there's only 5 trading days in a week. So using the RSI 14, you can use it. I'm not saying you can't, but it's kind of a random number, at least mathematically speaking. The only upside to it is that a lot of people use the RSI 14. So just like the moving averages, they become self-fulfilling prophecies. The RSI 14 is what a lot of people are looking at, and that's why it works a lot of the time. So you'll see here that pretty much anytime the price got a little overbought here, we did pull back a little bit. But a lot of the time, especially when you're trending, the pullbacks are not that strong. Now, what I like to use on top of the RSI is something called the percent range. And the percent range is kind of an ultra sensitive RSI. Instead of oscillating between 0 and 100, it oscillates between 0 and negative 100. So anytime you're below negative 80, this is generally oversold. And anytime you're above negative 20, it's generally overbought. Now, what I like to do is I like to use the Williams percent range 10. And then, maybe I look at the RSI 20. Because then we're looking back essentially 1 month. There's generally about 20 trading days in a month. So if I go here, make that 20, and you'll see some interesting stuff happens. Now on the RSI for Twitter, notice that the RSI 20 never gets below even really 35. So this is where you can kind of use the RSI and the percent range together. Notice what happens on the percent R. Anytime that the price really starts to get below, pretty much anytime the RSI gets, or excuse me, the percent range gets below, let's make this lower threshold like -90. For Twitter at least, this could be different for other stocks. You'll see that this is a very strong signal. So especially on the downside, anytime that the price bottomed out, generally it was right, at this area. And so I personally like to use the percent range over the RSI, just because it sometimes will give you a little bit of a better idea of what's going on. But you'll see here that, at least in Twitter, anytime the percent range has closed below that -90, it's been a pretty solid time to get in. So, literally every single time this has been a bottom. I like to use the 10. The 10's pretty solid. Look, every time we closed below, it was a bottom. So, if you are trading Twitter, you may want to use the percent range 10 as a as a lower indicator to get an idea of when trend is exhausting on the downside. Now, something to keep in mind, the upper side of the percent range doesn't always work exactly like that. Notice a lot of the time when the percent range became overbought, I don't like to call it overbought because it generally is just telling us that the trend is just starting to gain momentum. So this is when I like to use the RSI and the percent range together, because it allows you to see, and let's change this. For Twitter, it's just not really showing us anything. So let's change it to 15. We'll go look back 3 weeks. But the same thing, right? You'll see here that a lot of the time, the RSI getting above 70 was telling us, okay, we're maybe getting to the top here. We're starting to at least maybe get a little overbought. But notice here that the percent range is always going to signal first. So what I like to do is anytime that the percent range is starting to become overbought or above -20, that tells me that momentum is really starting to pick up. Notice here that the RSI becoming overbought generally was a little bit of a signal that we're starting to get toppy. But even on Twitter, it didn't do a ton. So what I like to do is I like to cross-reference these. So notice here, the percent range for November started to become overbought here. Notice that the RSI is nowhere near overbought yet. The RSI is only at like 52. And so, this is when you want to really start to say, okay, maybe price is getting a little overbought when the RSI gets overbought. But when the percent range goes above -20, that's generally signaling momentum is really starting to pick up. And it's not a sell signal. It's generally almost like an add signal at that point. Same thing here. If we look at this one, this initially became overbought on January 28th. That was really when the trend just started moving up. And notice that the RSI was only at 50 or 54 or whatever it is. And it finally topped out way up here when the RSI was at 86. So, a lot of the time, the percent range and the RSI can be used together because you can really see that the percent range is showing the momentum. Then the RSI is really going to show you when things actually do get overbought. So I don't even like to say this is like an overbought part of the percent range. I like to think of it as momentum is really starting to pick up. And even here, right? With Twitter now, the percent range started becoming above -20 here. And, the RSI was only 52, and the RSI still isn't overbought yet. That's not always going to be the case. You can sometimes have the percent range signal, but what I like to do is I like to look for divergence. So, if you have divergence on the percent range, that starts to become an issue. So notice here, when we were topping out in February, not only was the RSI becoming ridiculously overbought, but the percent range started to hit lower highs. So you could see on the percent range, momentum was starting to fade here. And so you can really use these two indicators together. Not only do you have the RSI getting way overbought, you also have the percent range starting to kind of trend down and hitting lower highs. And that was really your signal here, because you can see here, lower highs on the percent range, but higher highs on the price. So anytime you see that discrepancy where you've got the lower high and then you've got the higher high on price, that's called negative divergence. Positive divergence is when the price is going lower, the oscillator is hitting higher lows, and that's generally a pretty good sign that you're getting exhaustion of the trend to the downside. So one thing that you can do is you can create alerts on these lower indicators. So maybe you want to know anytime the Williams percent range gets back below -90, you just go to create alert, multi-factor alert. You can add condition, and you can say, in this case, we're on the daily chart. So you just do daily indicator, just type in Williams. And literally, if I type in Williams percent R, it kind of popped up quick. Let's do it again so you guys can see that a little slower. So daily indicator, Williams percent range automatically pops up. And you can say crossed down through the constant level, and we said -90. So let's say we start to break down. Whenever this percent range crosses back below -90 and closes below it, you'll get an alert. So you don't have to watch the chart every day and say, oh, how close are we to -90? You just put the alert in, and next time the percent range gets below -90, you're good to go. So it's something that really allows you to, do some of this stuff without having to necessarily, be at the computer all the time. It really just makes that whole process a lot more efficient. And yeah, it's just something that's really, really nice and helpful to stick to some type of plan or stick to some type of level that you want to enter, whether that's an oscillator, whether that's a horizontal level on the chart, diagonal level, whatever the case is. Yeah. So yeah, no, just a lot of different ways you can use the platform. We barely touched the surface. If this is something you're interested in, we do have a 7-day free trial, so you can try this out before you buy it, and you can really, you can get a taste for, is this something that works for me? And it's something that's for newer traders as well. Let's say that you want to learn different candlestick patterns, and you're not familiar with them. You just click this patterns button here, and you go down here and you say, all right, well, I want to know what 3 black crows looks like. You click apply, and anytime there's 3 black crows on the chart, I'm not even sure if there are any here. I don't think there are, so that's a bad example. Let's do maybe you want to know what engulfing candles are, or any type of, look at how many different patterns we have. You just go, you click engulfing, click apply, and anytime an engulfing candle pops up, it will highlight that on the chart. So you can start to train your eye on what's an engulfing. Anytime that this second candle here is, the body is overlapping this entire body, it's going to be a bullish engulfing. Anytime you have the second candle being a huge red candle overlapping this body, it's going to be a bearish engulfing. And so it can really just help train your eye, and there's a lot of different ways you can use the platform. We post a lot of things on Twitter to highlight a lot of other features we have, and we have a ton of different videos on YouTube that you can check out and see, different ways to utilize this to the best of your ability.
Cool. Thanks, man. I know you got a flight to catch, but yeah, I think one thing I'll add is TRENDSPIDER. It's an absolutely amazing tool to start your trading career. And if you combine that with the fundamentals, you can really do some good things with your portfolio. The one thing I'll add is it's so easy to confuse and overwhelm yourself with too many things. So if you stick to the basics, if you stick to what you just talked about, what I asked you to talk about today, you're going to be in great shape starting this out. Especially the moving averages is such a great tool to talk about, how you can spot patterns, how you can spot the bottom sometimes. And I know that was a big thing with the QQQ last month, when a lot of these growth stocks were touching the 200-day, and then some of the stronger ones bounce right off of that. And you've seen the response with some of those stocks. They're already up 15 to 20% just within the last 5 to 7 trading days.
Yeah, no, it was quite the balance. And if you do want to try it out, as I mentioned, we do have the 7-day trial, but we do have 25% off as well. DIG25 is the coupon code you can use. You just input it when you're signing up, and you can get 25% off any plan. We have monthly plans, we have annual plans, and then we have different types of levels that you can choose from. So a ton of different ways that you can utilize the platform. Touched on some of them here, but if you do want to check out some other ones like the raindrop charts, the anchored VWAP, the anchored volume by price, seasonality, all of these different things that we didn't touch on, just check out our Twitter. I post videos all the time highlighting all these other features as well. At TrendSpider on Twitter is how you can find us. And as I mentioned, DIG25 is good for 25% off and that 7-day free trial.
Cool. All right, man. Thank you so much. Appreciate it. We'll chat soon. But yeah, have a good flight. Have fun back home.
Thank you so much. I appreciate it. We'll talk soon. And thanks for having me. And thanks for everybody's time.
Thank you.